All right, today we're going to break down a real-world options trade on Meta. And this is a great one because it's not just about getting into a good trade, but it's about the much harder part, knowing when it's time to take your winnings and walk away. So let's dive right in. So the whole point of this analysis really boils down to one single decision that might seem, well, a little counterintuitive. We're all taught to let your winners run, right? But what if the smartest move you can make is to lock in a really solid profit and get out, even if it feels like there's still more money on the table?
And that really is the big question here. I mean, look at that, a 49% return in just 21 days. And this trade still had months left before it expired. So why on earth would you close that down? It might sound a little crazy, but trust me, by the end of this, it's all going to make perfect sense.
Okay, let's start at the finish line. On April 17th, we closed the position. Bam! A gross profit of $484 locked in. A win is a win, plain and simple. But to really understand the why behind this move, we've got to rewind the clock 21 days and see how this whole thing got started. So yeah, let's go right back to the beginning and take a look at how this trade was put together from day one. Because how you set it up is every bit as important as how you get out. Here it is, the entry. On March 27th, we opened what's called a bull put spread on Meta. Now, the key thing to notice here is the expiration date, December 2026. This thing had over 2 years to play out, which was a really important part of the initial strategy. And for anyone who's kind of new to this, a bull put spread is actually pretty straightforward. You're basically making a bet that a stock is going to stay above a certain price. You're kind of like an insurance company. You sell that insurance and you get paid a premium right away for taking on the risk. Now check out this risk to reward setup because this is what made the trade so attractive. We collected a premium of $1,020, but our total capital at risk was only $980. Let that sink in for a second. Our potential profit was actually greater than our maximum possible loss. That's an unbelievably strong setup. And frankly, you don't find those every day. We were starting from a position of strength from the moment we clicked buy. But here's where the story takes a little bit of a turn. See, a great trade on a single stock doesn't exist in a bubble. You have to pay attention to what the entire market is doing, and the market was starting to flash some pretty obvious warning signals. And this is just so crucial. The decision to get out of this trade wasn't really about Meta at all. It was about being disciplined, about managing risk when the market conditions started to change. You have to be able to read the room. So what were these signals? Well, there were 4 big ones. First, the S&P 500 just looked overextended. The rally was getting ahead of itself, which just increases the chances of a pullback. Second, the fear and greed index was sitting deep in greed territory. That's a classic contrarian signal. When everyone gets too euphoric, it's time to be careful. Third, the VIX, the market's fear gauge, was starting to creep up, showing some nervousness bubbling just under the surface. And finally, you know what? Just plain old discipline. A nearly 50% profit in 3 weeks is a home run. Why get greedy and risk letting that evaporate? So, based on all those outside factors, we made the call to exit. Now, let's really dig into the payoff, because this decision didn't just lock in a nice profit. It unlocked the power of something we call capital velocity. First up, the big number, the return on a risk. We made 49.4% on the capital we actually put on the line. I mean, that is just an incredible result for only 21 days. And in real dollar terms, that came out to a gross profit of $484. A solid, clean win. We'll take it. But this number right here is the real showstopper. 858.4%. What in the world is that? Well, that's the annualized yield. It's a way of looking at just how incredibly efficient this trade was. It asks the question, what if you could do this over and over again for a whole year? So let's just be clear on the difference here. The absolute return, that 49.4%, that's what we actually put in our pocket. That's the real profit. The annualized yield, though, is a bit more theoretical, but it shows a really powerful idea. By getting that return in just 3 weeks instead of waiting for many months, we dramatically increased the speed of our money. We freed it up to go hunt for the next great opportunity. And that really gets us to the most important lesson here. It's not just about making a profit. It's about how efficiently you do it and what that efficiency lets you do next. This quote from the original write-up just nails it perfectly. It's all about compounding velocity. You don't want your capital just sitting around for months trying to squeeze out a few extra percentage points. You put it back to work. You redeploy it. That is how you really accelerate the growth of your portfolio. And so that brings us to the final question, and this one's for you. We've got that $980 of capital free again, plus a $484 profit in the bank. The hunt is on for the next trade. So what would you do with it? Where do you see the next opportunity in this market? I really hope this breakdown was useful. Taking a profit is always a good problem to have, but understanding the why behind that decision is what separates a disciplined strategy from just getting lucky. If you enjoyed this case study, please go ahead and like this explainer and subscribe for more. We'll see you next time.